Hello friends, welcome to Prepper. So this particular video is in continuation to the course on monetary policy. Here I'll be talking about the concept of money. So money happens to be a corollary and extension to monetary policy that we would be discussing in this particular video. What exactly is money? What are its functions? And how is money represented or how is it given? So let's learn about the concept of money. So, if you are asked in a very generic definition or definition terms, what exactly is money? So, money is something that can be exchanged for certain goods and services. So, I have to purchase a good or I have to purchase a service. So, what can I give in order to purchase a good or service? I can give money. So, money is regarded as any object which is generally acceptable as means of payment. There are three keywords. Any object which is generally acceptable, generally, which means that everybody would accept it as a means of payment in transacting an exchange of goods and services. So, if you have to exchange the goods or services, that transaction in exchange of goods and services can happen, which is generally acceptable as a means of payment. That is regarded as money. So money is also a very complex as well as an easy phenomenon. Here it is written complex, but according to me, it's complex as well as an easy phenomenon. Complex, why? Because money also varies from country to country. It varies from territories to territories as a currency part. And something that is generally acceptable, it is not only in paper form, it can be in other form also. Like earlier there was barter system, then there became coin system. Coins were also of various types, various kingdoms had various coins. Then it came to paper notes, and then it came to other types of notes. So money is not limited to currencies only. This is why it is complex. Demand deposit of banks, this is also called as money. It also includes financial assets such as bonds, government securities, time deposits with banks, equity shares. All these are also considered to be money, which serve as store of value. This is considered to be store of value. So, money basically in any form is considered to be within the definition of money. So, it is not only the cash that you are thinking about, it is not only the money that you think about, literal money. Money's definition is very, very broad. So, what are the functions of money that money can play? Money is acting as a medium of exchange. You can use it as a medium of exchange. It can be used to exchange certain goods. You can give something in order to get something back as a medium of exchange. It can measure of value of unit of account. So, if you have to measure something, like for example, this is for 10 rupees, this is for 50 rupees. So, this is also important for money. You should have a measure of value in terms of money. This is for 50, this is for 100, this is for 200. These are considered to be unit of accounts. It is also considered to be a standard of deferred payment. You can take loans in terms of money and you can repay that loan in installments. So repaying the loan installments is called as deferred payment or deferred money. This is also an important function of money. And certain other functions of money is that money, if it isn't kept in paper currency, it does not deteriorate easily. It is kept easily. So all these are also functions of money. But major functions are medium of exchange. It can be quantifiable, means any object, good or service can be quantifiable as a unit of account, and it can also be used as a standard of deferred payment. So, what is the dynamic role of money? What exactly is the role of money? Money plays a very active and highly important part in the economic system of any country by influencing the general level of prices. So, the general level of prices are influenced by money, as simple as that. So, how are they influenced? It depends upon the money supply in the economy. If money supply is huge, if there is a lot of money in the economy, it can lead to rise in prices of goods and services. If there is less money supply in the economy, it can lead to fall in prices of goods and services. So the volume and function of money, volume, function of money. So it is the volume and function of money that can lead to rise or fall in the general price level, as I'd explained to you. So high money supply, high prices, low money supply, low prices. So money directs idle resources into productive channels. Whatever are the idle resources, they should be used for productive channels. For example, they should be used to produce something and thereby affects output. It would affect output, it would affect income of people, because if you are producing, if you are using the idle resources, you are producing something that would affect output. Output would increase, more people would get employment, so income would increase, employment would increase, consumption would increase, and consequently the economic welfare of the community at large would also increase. So money directs all these resources to productive channels. Like for example, if I have money, I would renovate a property and put it on rent. I would turn it into a guest house. That would promote the economic welfare of the entire city. I would give employment to certain people. I would list that thing as a part of a guest house that can be used as a hotel. So I would do many things. It is a resultant of economic welfare. So money makes it possible to have financial economic planning as a workable proposition of physical planning at the micro level and the macro level. At both the levels, money is possible to have the financial economic planning. This is what is money. So money plays a very dynamic role where if there is money, it would chase more money by putting the idle resources as productive channel. So that is the dynamic role of money. Now, how is money supply in India measured? Money supply in India. Money supply refers to the total supply of money in circulation in a given country's economy at a given point of time. At any given point of time, how much money is in circulation or in supply in a given country's economy, this needs to be determined. It is called as money supply in India. So it is considered as an important instrument for controlling inflation by some of the economists, obviously, because this is the thing that would lead to higher money supply, and if higher money supply, automatically higher inflation. So economists analyze the money supply and develop policies revolving around it through controlling the interest rates. How would the economists do? They would be controlling the interest rate. They would be increasing or decreasing the amount of money flowing in the economy. So all of these things would be happening, and this would lead to increase or decrease in the money supply in the economy. Consequently, increase or decrease in interest rates, and consequently increase or decrease in inflation. Any of these things can happen through money supply. So money supply data is collected, recorded, published periodically by the RBI. So how is it collected, recorded and published? This we need to understand. So if you are asked that how is money supply in India measured, that thing has to be given as the measures of money supply in India. So very popular measures M1, M2, M3, M4. We need to understand all these measures from the point of view of money supply in India. There are several measures of the money supply like M1, M2, M3, M4. We'll discuss them one by one. So the first measure is by the name of M1. So remember, this is the measure of money supply. So if you are asked that how is money supply measured in India, it is measured through all these four parameters. So RBI launches all these four parameters for telling you how much money supply is there in the economy. So M1 is also called as narrow money. It is the narrowest form of money or small money. So narrow money is equal to currency with the public, whatever currency is in circulation. Public means circulation. So coins, currency notes, etc. plus demand deposits of the public. Demand deposits. Demand deposits means the money which is deposited by people in banks. That is demand deposit. So whatever deposit that you have deposited in bank and that what you can demand from the bank back, it is called as demand deposits of the public. So M1 currency with the public includes currency notes and coins in circulation, but it excludes cash held by banks. Cash held by banks means the cash which is held by banks in the lockers, etc. That is excluded from this. So demand deposits on the other hand is the money deposited by the people in banks. That is demand deposit. And one specific deposit that is coming in narrow money are the other deposits with the RBI. Other deposits with RBI. These other deposits with RBI, very few people can do. Like for example, ex-RBI governors. The ex-RBI governors would have certain deposits in the Reserve Bank of India. So those certain deposits are included in the other deposits. Even these deposits are counted within the M1 or narrow money. So people issue checks against these deposits in the banks. So all these are called as demand deposits. And you have currency with the public. So you have all the form of cash plus cash which is with the public circulation, plus you have demand deposits, and plus you have other deposits with RBI. This is included in M1. Measures of money supply in India, M1, which is also called as narrow money. Now, be very, very careful. After studying M1, you should study M3. So remember, we are studying M3 after M1. M3 is called as broad money. So M3 is equal to M1. Do not make any mistake. This is M1 plus time deposits of public with banks. Time deposits. So M1 वाली चीजें तो आती ही हैं. M1, whatever we had included in M1, M1 had demand deposits, other deposits, and currency with the public. Plus you also had time deposits of public with banks. You would get broad money or you would get M3. So in M3, FD, fixed deposits mean time deposits, the deposits that you can only withdraw after a certain time, which is why FDs are included, with a time barrier, are also included for calculations. This is M3. The reason why they are included in the calculation of money supply is because in case of fixed or time deposits, the depositors can borrow from the banks against them. So whatever you have put, you can borrow against them. That is why it is included in the money supply. In some cases, the depositors are allowed to withdraw their deposits after foregoing some interest and paying a penalty. Like for example, you can break your FD in between. So what they do is they'll charge you a penalty and they'll break your FD in between. So the basic difference between M1 and M3 is the treatment of time deposits with the banks. It is basically time deposits with the bank. This is what M3 is. So remember the order in which I am teaching. It has to be M1. M1 is narrow money. Then comes M3. M3 is broad money. Now we will do M2. M2 is equal to M1 plus post office savings deposits. So here also M1, M3 also had M1. Post office savings deposit. If you know, the post offices were also designated to function as banks by the government of India long back, many decades back during 1970s. So post office savings deposits are far less liquid than commercial bank savings. They have withdrawal restrictions. You can't withdraw much. They don't serve much as a medium of exchange. So post office savings deposits are used mostly in rural areas because their post offices are used as banks. Hence, M2 is equal to M1 plus post office savings deposit. So in M3, we add time deposits. In M2, we are adding post office savings deposits. What is common between M2 and M3 is this M1. So remember that M1 is equal to something, M2 is equal to M1 plus, M3 is also equal to M1 plus. M3 is not equal to M2 plus. Do not make any mistake in this particular thing. Please. This is what M2 is, M1 plus post office savings deposit. So here we include all the deposits which are put by people in the post office savings account, M2. And now coming to the last measure, that is M4. So M4 is equal to M3. M4 is equal to M3 plus total post office deposits. Total post office deposits. So here M3. So post office deposits were not there in M3, which is why we are adding it specifically. And this includes FD with the post offices as well. Because in M2 we had included post office savings deposits only. Here we have included total deposits, which is savings plus fixed. So it is with a view to treat post office savings deposits as separate from the commercial bank savings deposits that M2 and M4 series of money supply have been provided by the RBI. So these are the four measures of money supply, namely M1, M3, M2, M4. And this is how we determine the money supply in India. These are the four important measures of money supply in India. So this is a specific topic in extension to monetary policy by the name of money. Hence the concept of money. So how does money supply increase? What is the multiplier effect of money supply? Let's understand. As a customer makes a deposit into M1 deposit account, the banking institution will use this customer's account in order to lend. So he would lend funds. Where would he lend funds from? He would use the deposit account of the consumer only. Remember, M1 is equal to demand deposit beyond the reserve to another person. So he would be using certain portion, certain would be put as reserve as CRR, SLR, and the rest would be lent to another person. Original depositor maintains the ownership of initial deposit. So these two funds, whatever he had deposited, this belongs to this original depositor. These are the funds which are used by the banking institution to lend further. So funds created through lending are generated based on those funds. If the borrower subsequently deposits the funds received from lending institution, whoever the borrower is, whoever have borrowed from this particular banking institution, he would also lend to a financial institution or a bank. This raises the value of M1 even through no additional physical currency actually exists to support the new amount. So let me explain it to you. If you deposit 1000 and banks lent 800 out of it, thus when loan is returned, the 1000 rupees have now become 1800 rupees. So you would be returning 1000, 800 would be returned by someone else. So that would be 1800. This is what the multiplier effect of money supply in India is. So the money supply also has multiplier effect. So basically the same money is being multiplied and being used again and again. So here we come towards the end of this particular video, concept of money. So stay tuned for other courses. Thank you so much for watching this video. Bye.